What if you could have an extra $1 million in retirement by not working any harder and not changing your cash flow? Well, that's what we're talking about today. Stick around.
Enjoy the episode.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad, along with Nelson Nash's infinite banking concept.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso, the recovering CPA. He told me to say that. Today, we're jumping into Nelson Nash's Becoming Your Own Banker. We're doing a book review, and we are in one of my favorite sections, which is equipment financing. So let me set the stage a little bit for you guys, and then we'll kind of dive into it. We're right about in the middle of the book, but up until this point, Nelson has introduced us to the idea of infinite banking, some of the human characteristics and human problems that come along with trying to create your own banking system. And just recently, right before this section, he has introduced us to the fact that a properly designed whole life insurance policy is a great place to store cash. And he's compared that with several different options. We ran through the comparisons on page 44, 45 that shows that whole life is the best place to store cash. And so now we're expanding on that, right?
Yeah.
I'm excited.
Well, it's interesting. I was going to ask you what this section, what your excitement level of this section. You said it was one of your favorites.
It is. Page 44, 45 is probably my most referenced pages in the book. But this section for me is really the section where I dove into it when I first read the book, and I took time to go in there, figure it out, and kind of see what was happening. So
this one gave me the most sleepless nights. Again, there's a lot of numbers on here, and I like to see the numbers, and just reading that and thinking, what if I would have done this earlier?
Ooh.
And I'm like, well, at least I can do it now.
Yeah.
So, but this section here was a good staple of really the impact of infinite banking compared to using somebody else's bank.
I agree. Yeah.
And what Nelson does in here, I'm going to briefly review the chapter and the numbers, and then Cameron and I are going to share some of our highlights of this section.
Also known as nuggets.
Nuggets?
Yeah, we got some golden nuggets.
We got some nuggets.
Yeah.
Okay, so let's get started here.
Let's go.
Okay, now I know most people are probably listening to this while they're walking or driving in their car. We do have this on YouTube and a video, but however, we're going to go through some of these pages. However, we're just going to go over it at a high level. So we're acknowledging that many people won't be able to see the video. So we will just be walking through and giving you some of the highlights. Of course, if you ever want to see the actual numbers, feel free to subscribe to our YouTube channel and you can see it there. Now, the first illustration that we have here that Nelson has, this is one that we call the do nothing plan. Right? Because all he's doing is funding the policy for 4 years of $40,000 each. And at the end of year 4, Cameron, how much cash value do we have?
He's got $157,000.
$157,000. Okay. And then he doesn't put anything else into this policy. He just lets it grow, lets it compound. And then what Nelson did on these illustrations, he stopped funding it at age, or we started taking money out after 65. Okay. So at 65, Cameron, how much money do we have?
He's got 1.5 million.
Okay. 1.5 million. And he's taking that into cash, or some of it into annual cash flow. And how much are we taking each year?
92,000.
Okay, Cameron, what's the tax rate on that?
0.
Okay, perfect. One thing I wanted to show on here is that what Nelson is trying to do is show how much you can take out and still maintain the death benefit. So the death benefit is the same at 65 as it is at 84. Now, what that also means is if you aren't concerned about the death benefit, you could take out more. Or if you are concerned about the death benefit, you could take out less. But what we really wanted to compare is really at the bottom line, At the end of the day, at age 65, how much cash are we going to have in these different scenarios? We call this one the do nothing plan because all he does is fund it and then do nothing. Now, we look a little deeper into this guy's business. He has a logging business, which is very equipment heavy, meaning he needs a lot of expensive equipment. And what this guy realized is that he's going to these finance companies and he's borrowing the money to pay for these trucks. In this example here, truck is about $66,000. He has to put a down payment, but he's financing about $50,000. And the monthly payment on that is $1,500 a month, or the equivalent of $1,800 thousand a year. So what this guy does, oh, hey, instead of me using money from this finance company, what if I use the money for my policy? And I take that money and I use that to buy the equipment. And then instead of paying the finance company the $18,000 a year, what if I put that back into my policy? And that's what this next illustration is. As you can see, Cameron, how much cash value do we have at year 4?
157,000.
Okay, same as the last one. So this is just showing that this is the same numbers or same illustration that we looked at before, but instead of doing nothing, he does something, and he's financing one truck, and that truck is $52,600. His payments annually are $18,000. So that first year he's taken out a net of $34,600. Then each year he's putting in that $18,000 a year. And like most pieces of equipment, you need to buy another one. So he needs to buy another one about every 4 to 5 years. So he's financing one truck every year. And then again at 65, now at 65, after him financing one truck through the same policy, how much does he have in cash value now?
He's got 1.98, or known as $2 million.
Okay, let's round it to 2 million. And then how much is he taking out each year?
He's taking 125,000.
Okay, Cameron, I know you're not
Say
a
it.
CPA or even a recovering CPA, but what is higher, 90,000 or 125?
125.
Okay, good. Okay, perfect. So by financing one truck, he has about $500,000 more. And did he work any harder?
No.
Did he take on any more risk?
No.
Okay, he has $500,000 more. But Cameron, you started this podcast saying we'd have $1 million more. Well, what he realized, he finances more. He has more than one truck. So he's like, what happens if I finance 2 trucks from the same policy? Now, again, Cameron, how much cash value do we have at year 4?
157,000.
Okay, again, same policy, same cash value, but now instead of financing one truck, he's financing 2 trucks. And now we skip down to age 65. Now, Cameron, how much does he have?
He's got $2.5 million.
Which is how much more than the original one, the do nothing?
That's $1 million.
$1 million. Did we change his cash flow at all?
No.
All we did was change who the check was made out to. Instead of that money going to a finance company and somebody else, that money went back into his policy. And now he's able to take more cash flow in retirement. Now, Nelson does do this for multiple trucks. However, I don't think we need to go through it every time. But the bottom line is, the more he uses the policy, the more cash he's going to have. Thoughts or questions, Cameron?
No, I like the way you ended it. The more you use it, the better it gets. And that is actually counterintuitive to a lot of the products that people are using, right? Most of the time, people are telling you, don't use this, put it over here, set it aside, leave it. And that's the best thing that you can do with it. But again, I think one of the reasons this section is so powerful is because it's teaching people that you do have control, right? And the more effort that you put into this, the better this thing is going to perform over the long run.
Perfect. Now, Cameron, I know we are going to share some highlights where you call nuggets. I will say I'm a little disappointed. I took a little glance at yours.
I bet you did.
Well, I didn't.
I bet you did. Yeah.
Well, all I needed to see, Cameron,
Mm-hmm.
because somebody emphasizes the important that words matter. Okay. Now, I noticed that.
No idea where you're going with this.
Well, yeah, I'm about to show you.
Okay.
What words did you use to highlight this section? Like your nuggets. What's the name of the Word document you used?
It's called page 51.
Page 51. Okay. All right. Not much effort into there.
It's the page I started on, man.
Okay. All right. Now, somebody who might have taken a bigger, maybe a deeper look, maybe has more respect for Nelson. Maybe he's read the book more. Maybe that's why. But you want to share what I called my nuggets?
Oh my goodness. He wrote the wisdom from page 51 to 64 from the late, great Nelson Nash.
Okay. So I just saw that your word, and I'm like, hopefully he has some good nuggets here. But so let's hear him, Cameron. I got you on the spot here.
You do? Well, I've got a bunch. I went through, reread this section, and just kind of started making notes. Obviously, I started on page 51. Thank you for highlighting that. But one of the first things that popped out to me was on page 51. Nelson makes a statement. He says, you must build the capitalization phase over a period of time, such as a 4-year minimum. I literally had this phone call this morning with someone that called in and wanted to talk about infinite banking. And they had almost repeated that phrase back to me verbatim and said, hey, I understand that this is a long-term play, that I've got to fund this thing over a 4 to 7 year period. And I kind of sat there and I was listening to him. I let him finish, and I wanted to share with you guys what I said. I said, well, if you read Nelson's book, that's exactly the way that he set it up. I go, but this book is published in 2000. Nelson kind of created these ideas over a period of years. So these ideas in this process that's outlined in the book are probably 20 to 30, maybe 40 years old. I go, if you look at some of the opportunities we have now today with the products and the way the insurance companies have embraced the way that we're trying to manipulate or design the policies, man, we have clients that are accessing cash value within the first 30 days. So this idea that you've got to wait 4 to 7 years to access the cash value, I would say it's untrue, right? So if you're out there and you're thinking, man, I got to wait, this is a long-term play, it's not as long as you think by any means. So that was the first one that jumped out to me.
Well done, Cameron. And I hate to say it, but that was part of the first thing that I wrote down too, is the
that's weird how you looked at my notes
of capitalizing.
You were going to say the same thing.
But you know what? Well, on that note, and you can even see it, I expanded on it.
Please do.
Because what he says, you must build the capitalization phase over a period of time, such as 4 years minimum. You may find it necessary to accumulate capital over a longer period of time. Indeed, additional capital makes the system more profitable. Just want to take what you got and add a little, just take it up a notch. Another, you made a really good point. A lot of times people, after reading the book, think, oh, I can't really use my policy to year, 4 or 7. But we've had many conversations with Nelson. Maybe I had a little more, but it's not, we're not keeping score. But we had asked him about this, and he had said that his goal on these illustrations were to really carve out the impact of the banking function. And he said that if you have a need for financing, you should start using the policy as soon as you can. He just wanted to emphasize the power of capitalizing. However, you need to use it when you need to use it.
Well said. One of the notes I wrote down was actually kind of a question. As big of a fan as I am of infinite banking, I was thinking about if I had to wait 7 years to access the funds. And so that was the question I was going to pose to our listeners, is how many of you guys would still be clients if you had to fund a policy and did not have access to that cash value for 7 years? What percentage of clients do you think we'd have?
Well, I think I'd be doing taxes. Okay.
I agree with you. And then I kind of I brought it back down. I said, well, how many would we have if we had to wait 4 years to access cash value? And then I had a conversation with somebody just a few days ago, and they have a policy. They used to live in Canada, but they said that they could not access cash values for the first year.
Mhm.
So there was restrictions on the first 12 months, and even some insurance companies in the U.S. have restrictions on accessing or policy loans in the first 12 months. So again, I thought it was a good thread to think about, right? If you're passionate about infinite banking, like what are you willing to endure
Mhm.
to practice or participate in it? And thankfully, we don't have to go through that. It's just a kind of a thought exercise, but I thought it was an interesting thread.
What I would pose back to somebody who says, well, I don't want to wait 7 years to be able to use the
Mhm.
money. How long are you waiting for the money you're putting in your government created 401k plan or IRA? You're going to wait till you're in your 60s to really use it. But now with infinite banking, we have that ability for you to use it now
Yeah.
and for it to continue to grow. So I get it where people, well, that's one of the hindrances that I put in a dollar, can't access a dollar. But compared to what most people saving for retirement is a government created plan where you put in a dollar, very difficult for you to access that dollar until you're old.
Hmm. People love the idea, but they hate to wait.
Mm, well said.
Yeah. Awesome. I've got more. I got more
Let's
nuggets. Yeah.
give it.
Page 51. Up in the top right hand section, he's discussing a few things, but what he talks about is uh, dividends equaling premiums. He's alluding to that concept, and he says resulting in no out of pocket outlay, having a paid up policy or having the policy pay for itself. Anthony, how many times have you had somebody call in and say, "Hey, how soon can I have this policy pay for itself?"
I spoke to a young gentleman yesterday.
Not yet. Same, right? Not no. I mean, I had a conversation recently about literally the same thing. We're looking at an illustration. They go, "Well, how quickly can I have this thing pay for itself?" And the question I asked him was, well, "What are you trying to get accomplished with that? Like, what's the goal? How does that line up with what your goals are?" And so, Anthony, when someone asks that question, how do you typically address it, or what are your thoughts on having no out of pocket outlay on a policy?
I always ask them, are you viewing your premium as a payment or a deposit? I view a payment as money going to somebody else and a deposit coming to me in the account that I own and control. And we need to view our premiums as deposits. And yes, there are a lot of options if you're unable to fund the premiums, but that should only be in a situation when you want to stop building assets,
Mm-hmm.
or if you are not able to fund it. Most of the time that I see people, what's interesting, we even see agents that promote this, not infinite banking, but they promote whole life insurance, of the ability that you can have the policy pay itself, so it's
Mm-hmm.
no out of pocket. But then even the agents are viewing this as really this premium as an expense, and we want to stop expenses as soon as possible. But if we can view this as an asset, when do we want to stop having assets? Cam, do you answer it in a different way?
No, I answered in a much better, more eloquent way. But I'm gonna say this: is that if you look at what he's referring to, is he's referring to that do nothing example
Mm-hmm.
where he funds it
Yeah.
for 4 years and then stops it. That is the exception to the examples that he's given in the book, right? If you look at the other follow-up illustrations, is there is additional funding, right? He calls it interest versus premium and stuff. But I remind clients, don't stop there, keep on going and keep reading, and you'll have a better understanding. That's not what he's trying to tell you to do. And in fact, just a few paragraphs earlier, he was talking about how much additional funding, additional premiums will have as an impact on the policy moving forward. So I brought that up because we do get that comment often where somebody's trying to get to a point where they can stop paying on the policy. And again, I like what you mentioned, Anthony. It's really about the way that you're approaching the policy, just from a thought point of view. So thought I'd bring that up.
Can you mind if I add a little something?
I don't
here?
know. I got a whole list here.
I know
but,
you do.
Yeah.
I'll just do a couple because
Okay.
you do have a long list. I tell you, one thing I want to point out is, as Cameron had alluded to, these policies were designed 20 to 30 years ago when interest rates were much higher than they currently are now. And so if you were to fund a similar policy, it's going to take more than 4 years than for your cash value to equal your premiums. Right? I just want to set some realistic expectations. And
Mm.
that's why Nelson even said you may need to fund the policy longer to get the same results, but it will be more profitable. So that is a prime example of what Nelson is talking about. Also, what is interesting, he stops funding after year 4. He does mention it in the book, and I think a lot of people overlook it. Premiums are still being made.
Mm-hmm.
What he's doing, they're using the dividends to pay the premium. And if that's not enough, they're actually taking a withdrawal from the cash value to pay the premiums. Now, that is not something that we would recommend, and neither would Nelson. But just how we mentioned earlier, Nelson really wanted to just carve out uh, the banking piece of the policy. So that's why he's doing it. That's why he's doing it that way. Ideally, we would encourage clients, if we're able to fund that 40,000 a year, where you got to put it somewhere in year 5, in year 6 and 7. So we should ideally establish a policy, or one policy that can hold all of those deposits for a longer period of time.
Well said. I'm going to add to that. Bottom of page 52 is where he's describing that. He says this extra money does not go to the general portfolio company. It goes to the policy as far as kind of a loan repayment.
Mm-hmm.
I've had this conversation a whole bunch, and so I'm going to give you guys a nugget here. This is specific to policy design. Anthony, you probably learned something here too. Is that with policy design, oftentimes we'll create a policy that is accommodating somebody's funding now today.
Mm-hmm.
But typically, Anthony, as you know, income increases, right? We get better at our job, we ascend the ladder, we get more efficient, whatever, but we end up with more money a few years into the policy. And so one of the things that I would recommend that your practitioner or should be doing, or if you guys have a policy, look to see if you have what I would call a buffer on your policy. So maybe you set up that policy for $7,000 of premium towards the PUA annually. You should have in there kind of a buffer. What I mean by that is you can manually change the amount that goes to the PUAs each year. So you can increase that and maybe by a few $1,000s. So you might be scheduled to pay 7,000 towards the PUAs, but you have the ability to pay maybe up to 10. So maybe an extra 3 is what I would call that buffer. The reason that I would do that I recommend clients have that on their policy is because there's going to be a lapse of a couple years where you've got just a little bit extra savings, but maybe it's not enough for new policy. And so as somebody maxes out that buffer, if they do that 2-3 years in a row, that's a great time for them to start to consider policy number 2. So hopefully that helps.
Well, I would say sometimes we might design it where there is no buffer. And however, again, if we're doing infinite banking and your income's growing, your cash flow is good. Your need to store capital is going to be larger. So we can still use that first policy, but the only way that extra interest is going to increase a policy is by premiums, not just by paying interest. But what we could do is just have that repay the loan, and at a certain point, we could look at maybe with this extra money, maybe it's time to get another policy. Maybe it's on you, or maybe it's a spouse or a child. But Cameron, what Cameron's showing is that there's a lot of different ways to design it, and you need to be working with somebody who's going to be listening to your needs and your goals and designs a policy accordingly.
Well said. What else you got, Anthony?
One thing he talked, this might have been the first time he talked about it. He talked about backdating. And what backdating means is that you really date the policy a few months prior. Now, the advantages of doing that is we're able to fund the policy sooner, right? Again, we're not looking at that premium as a payment. We're looking at it as deposits. So oftentimes, if we have some extra cash, one of the things we can look at is doing a kickstart, but sometimes a kickstart may not be conducive. So one thing we may do is just backdate the policy, and we can do that up to 6 months. And that allows you is really you're paying that money in month 6, but you're getting credit as if you had funded it in month 1. So you get that compounding and you get those dividends, even though you hadn't funded the policy. Now, depending on what insurance company we have, sometimes they have restrictions where we can only do it if it's going to lower your age. But again, this is just something of the different ways that we can design your policy.
Nice, well said. I had an example, page 52 at the bottom.
Mhm.
What he's talking about how someone should be in 2 businesses at the same time. Typically, your occupation, how you earn your income annually, but also the banking business. And one of the things that he mentions here is he should be. He says, look at how you're building equity in your equipment. That's true, but he is building equity in the wrong place. We talk about collateralizing, borrowing against whole life policies a lot. And you can do that with other assets. So the other day, I had a conversation with a gentleman. He called in. He's got an investment account. He's borrowing against that on margin loan, and he's using that for an investments. And he had not heard about infinite banking until recently. And he called in and he was excited because this sounds like a way better option. I've got more control. I can borrow more. And so he started to list all these advantages off to me. Right. And so I just reinforced what he said. So the ability to borrow against certain asset classes is nothing that's special. But if you guys do have loans against maybe your house or an investment account, do compare it with kind of rearranging some of that and look at a life insurance policy because of the opportunities that come along with that. So that's a conversation we have often.
Cameron, that point was so good that it made it onto my list of wisdom from page 51 to 64 from the late, great Nelson Nash.
Wow.
Well
I'm
done.
glad I went first.
Me too.
Glad I went first. Awesome, man. Let's see. You got
What
any
else
others?
you got? Well, you just took one of mine. So
yeah. Page 53 says the wisest thing he could do is add additional policies to his banking system as early as possible. Anthony, the question I had for you was typically when and how often are clients adding policies? So how often do they do it, and what's a good trigger for them to add one?
what I think at the beginning, a lot of times people have a hard time grasping more than one policy.
Mm-hmm.
And if that's you, don't worry about it. Just focus on the policy that you have at hand. And one of the things that I would look at triggering, well, I tell you, I believe that I want to maximize the policy that we do have to ensure that we're maximizing that. But as we have extra cash flow, we get a windfall, we have a raise, maybe we change jobs so we can free up some of that money. That is a great time to look at another policy. And we haven't talked about how long to put the PUAs on for, but sometimes we'll look at what that extra money is. Maybe it's kind of too small to really start a second policy, but oftentimes what we can do is that first policy has been around for a few years. I would say at least 4, hopefully 5 or more. Maybe we drop the PUAs on that one and then we put it into the new one. And you know what we could also do is most of the time, depending on the company, those PUAs are flexible. Meaning, so maybe we've maintained your cash flow and we have that other policy, but now when a mini windfall comes in, now you maybe that's when you pay the PUAs on that first policy.
Yeah, well said. Awesome. I've got more.
Do it. Let's get it.
Page 57. I thought this was funny, man. I read this and he says, hopefully I won't have to draw little pictures for this reasoning to be understood. On that same page, he refers to banks as bloodsuckers. You read this page and I'm like, man, Nelson sounds pretty annoyed here.
Mm-hmm.
And the thought I had is I completely understand, as I too get annoyed when I have to teach you IBC multiple times a week.
And you got to draw me pictures.
Exactly. Draw little pictures. Here's a bank. Here's a borrower. Here's a saver. So that was a good one. What else we got here? I think that's a lot of mine.
Well,
Ooh,
I
go
think
ahead.
I think I have one more, and then you can end us
Okay.
with that good one that
All
you
right.
gave a ooh for. One thing I wanted to point out of the design on this policy, it was $40,000,
Mm-hmm.
15 going to base, 25 going to PUAs. That's pretty close to a 60-40.
Mm-hmm.
Just wanted to point out the founder and creator of the infinite banking concept was not doing 90-10s. He was a fan of having a large base. And depending on your situation, we will design a different spread, but we have to look at more than just cash value in the short run. Because also, what's going to make the bigger impact on your dividends is going to be a higher base premium. Now, right now, we're in a low dividend environment. So the difference between a high dividends on a higher base and a lower base is still higher with a higher base, but it's not the impact is not as large. However, once dividends start increasing, that spread is only going to increase.
Well said. Well said. Last point that I had here was really a takeaway looking at page 54 and then the subsequent examples that he provides. Um, when you look at kind of page 54, the do nothing example, the insurance company had 100% control of that money. But also, what I would tell you is that's not banking. So oftentimes clients will come in and they ask for an illustration, right? Because they want to see what an illustration is. They want us to send it to them. And I can't emphasize enough that just a whole life insurance policy is not banking. It's not infinite banking. What he's doing in these examples is he's showing you the process of putting money in, borrowing against it, paying it back. And if you guys are struggling with that on a personal level, is I would say call us. One of our favorite examples to go through with clients is called the borrowing strategy. It's a calculator where we'll build something to your specific scenario, and then we'll build in and show you exactly what it looks like if we do loans and we pay it back over time. And so that's one of the most powerful examples that we have. And so that would be more of an updated, realistic example of this section for you guys. So if you guys are out there and you guys have questions, feel free to reach out and ask us specifically about the borrowing strategy.
Perfect. Now, my favorite point of this chapter, and you had touched on it, we started with the same policy. We still had 157 on all three of those policies. The impact of the additional $1 million had nothing to do with the insurance company. It had everything to do with how you use the policy. So we would encourage you focus on using that policy, and ideally we like to use it to buy assets, ideally to create enough passive income to be more than your monthly expenses.
Nice. I've got two takeaways to wrap this up. One, for me, one of the big takeaways is the realization that banks don't let money sit, only people do. And I remember, and I think that this section for me was powerful, is because it laid out an example that everybody can relate to, which I think was Nelson's intention, right? Everybody's buying cars, so that's easy to relate to. But I still remember when I first had that kind of aha moment with infinite banking, and I realized that I was the guy that had all my money at deposit down at the bank, and then I had two car loans with him, and I realized they're
Hey.
they're lending me my own money, charging me an interest rate for the privilege of having access to my own dollars. And so I'll never forget that. And that's when it really clicked for me. So that was the first realization or first takeaway. The second one that I had was that I believe that this section right here is probably one of the main reasons why people are drawn to infinite banking, is because this is showing people that you can have control over your destiny, especially your financial future, right? What this is showing you is that the more you use it, the better it gets, but it's on you to be educated and disciplined to go and save up the money, capitalize, but also pay yourself back with interest. And so I think that gives a lot of people hope, because right now I think a lot of people are out there and right, they're feeling pretty hopeless. They don't know how their plan is working out. The traditional model is a lot of smoke and mirrors. And so they don't know if it's going to work out for them. And so I think that's why a lot of people are turning to infinite banking.
Cameron, I remember the moment when the light bulb went off, when you kind of put it all together, and I'm like, Finally, all these hours of teaching this kid infinite banking, it's finally worked.
Oh, man.
Great job with these nuggets, Cameron. Appreciate the value that you're bringing.
You too. Well done. And values for you guys. So hopefully you guys enjoyed this episode. We went into the equipment financing, pulled out some nuggets for you, but also went through the book. So I hope you guys enjoy this episode.
Go make it a fantastic day.
Take care.
If you like this video, I know you'll like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.